Something remarkable is happening, and it's happening quietly beneath the noise of markets and headlines. $1 trillion is not just a number, it's a confession. It's the moment an empire admits uncertainty, when confidence gives way to fear. Today, the United States is signaling that it is ready to pull the plug on its deepest economic entanglement with China. And that decision tells us far more about America than it does about Beijing. $1 trillion is not a victory lap. It is not a symbol of confidence or control. It is a confession. When a nation as powerful as the United States signals $1 trillion shift away from China, it is revealing something far more uncomfortable than policymakers are willing to admit: fear. Empires do not make moves of this magnitude when they are secure. They make them when they feel threatened, exposed, and unsure of their future. For decades, American leaders insisted that economic integration with China was a masterstroke of strategy. We were told it would open markets, spread prosperity, and ensure American dominance through financial leadership rather than military confrontation. That story is now collapsing under its own weight. If globalization had truly worked on America's terms, there would be no need for an emergency pullback measured in the trillions. This is what panic looks like in economic form. Capital does not retreat unless risk overwhelms reward. The fact that Washington is willing to absorb massive disruption, higher costs, broken supply chains, inflationary pressure, reveals that decision makers believe the alternative is worse. The $1 trillion figure exposes how deeply the US economy tied itself to a rival it no longer trusts and can no longer control. What is being sold to the public as strategic strength is, in reality, damage control. When leaders talk about protecting national security and defending American interests, they are attempting to mask a deeper failure: the inability of the system to manage its own success. American capitalism helped build China into a manufacturing and technological powerhouse. That outcome was not an accident. It was the logical result of profit driven outsourcing on a global scale. Now that the consequences are clear, the response is not accountability, but retreat. The $1 trillion shift is an attempt to reverse history without admitting responsibility. It is an effort to contain a competitor that emerged precisely because American corporations demanded lower labor costs and higher margins, regardless of long-term geopolitical consequences. This move also exposes a profound contradiction. The United States champions free markets when they favor American dominance, yet abandons them the moment competition becomes real. If markets were truly neutral, there would be no need to pull the plug. The scale of this decision proves that markets are political tools deployed selectively to maintain power. Most revealing of all is who bears the cost of this confession. It will not be the executives who benefited from decades of outsourcing, nor the investors who reaped enormous returns. It will be workers facing higher prices, industries scrambling to relocate, and communities once again told to sacrifice for the sake of stability. $1 trillion in this context is not an investment in strength. It is the price of denying a systemic failure. Globalization was sold as an economic miracle, a promise that the free movement of capital, goods, and labor would create shared prosperity across borders. American workers were told not to worry about factories closing or jobs moving overseas because new opportunities would emerge, wages would rise, and the economy would become more dynamic and innovative. That promise repeated for decades by politicians, economists, and corporate leaders, has proven to be deeply misleading. At the center of this broken promise lies the outsourcing of American manufacturing to China. Corporations frame this shift as efficiency, as modernization, as the unavoidable logic of the global market. In reality, it was a calculated decision to exploit cheaper labor, weaker labor protections, and government supported industrial policy abroad. Profits soared, executive compensation exploded, and stock markets celebrated, while entire regions of the United States were stripped of their economic foundation. Communities built around factories did not simply adjust, they collapsed. Jobs that provided stable incomes, benefits, and dignity were replaced with precarious service work, temporary contracts, and stagnant wages. The social consequences were devastating: rising inequality, declining life expectancy, underfunded schools, and a growing sense of economic insecurity. Globalization did not lift all boats, it drilled holes in some while turning others into luxury yachts. China, meanwhile, did exactly what the system allowed and encouraged it to do. It used access to global markets to build infrastructure, expand technological capacity, and develop a skilled workforce. This was not cheating, it was learning. While American corporations focused on quarterly profits, China focused on long term industrial strategy. The result was a dramatic shift in global economic power that American leaders now pretend came out of nowhere. The broken promise of globalization is also evident in wages. Productivity increased, trade expanded, and corporate profits reached historic highs, yet workers saw little of the gains. The wealth created by global integration was captured at the top, while the risks were pushed downward. When factories closed, workers were told to retrain. When wages fell, they were told to compete harder. When entire industries vanished, they were told this was simply the price of progress. What makes this failure even more striking is the absence of accountability. The same voices that championed globalization now blame China for the outcomes they designed. The narrative shifts from free markets benefit everyone to foreign competition is the problem, without acknowledging that the system functioned exactly as intended for those who controlled it. Globalization did not fail because it was interrupted. It failed because it was implemented without regard for social consequences. It prioritized capital mobility over labor security, corporate freedom over democratic control, and short term profit over long term stability. The promise was shared prosperity, but the reality was concentrated wealth and widespread dislocation, revealing that the problem was never globalization itself, but who it was built to serve. Economic dependence rarely announces itself as a problem until it becomes impossible to ignore. For years, the United States treated its growing reliance on China as a manageable risk, something that could be balanced by financial dominance, military power, and political influence. Cheap imports kept inflation low, corporate profits high, and consumers satisfied. As long as the system delivered short term benefits, warnings about overdependence were dismissed as alarmist or protectionist. That complacency has now turned into panic. Supply chain disruptions, trade tensions, and technological competition exposed how deeply embedded China had become in critical sectors of the American economy, from pharmaceuticals to semiconductors, from consumer electronics to industrial components. The United States discovered that it no longer controlled the foundations of its own production. What once looked like efficiency now looks like vulnerability. The reaction has been swift and dramatic. Policymakers speak of reshoring, friendshoring, and decoupling as if these were simple technical adjustments rather than admissions of strategic failure. Rebuilding supply chains is expensive, slow, and disruptive, yet the willingness to pursue it reveals how seriously decision makers now view the risk. Dependence has crossed a threshold where it is no longer tolerable, and urgency has replaced confidence. This panic is not about values or ideology, it is about power. Economic interdependence works only when one side retains leverage. The moment that leverage weakens, cooperation is redefined as exposure. China's ability to move up the value chain, develop advanced technologies, and influence global trade rules undermined the assumption that it would remain permanently subordinate. The United States did not anticipate a partner becoming a peer, and certainly not a competitor capable of setting its own terms. What makes this moment especially revealing is that the dependence was self inflicted. American corporations made rational choices within a system that rewarded cost cutting and punished patience. Governments facilitated these choices through trade agreements, deregulation, and tax incentives. The resulting integration was celebrated as progress, even as it eroded domestic capacity. Panic now replaces praise, but the underlying logic remains unchanged. The consequences of this shift are already being felt. Companies face higher production costs, consumers confront rising prices, and workers are once again told to endure disruption in the name of national necessity. The urgency to escape dependence does not come with a plan to address who pays the price. As before, the burden is pushed downward, while those who benefited from dependence are shielded from its fallout. Dependence turning into panic exposes a fundamental instability in the global economic order. Systems built on profit maximization without strategic foresight are inherently fragile. When conditions change, they do not adapt smoothly, they lurch. The current scramble to pull away from China is not a carefully designed transition, but a reactive move driven by fear of losing control over an interconnected world that no longer behaves as expected. Economic decoupling is presented to the public as a patriotic necessity, a bold move to protect national interests and restore economic sovereignty. The language is deliberate and emotionally charged, designed to rally support and silence criticism. But behind the rhetoric lies a far more familiar pattern. This is not a strategy built to uplift working people. It is a defensive maneuver by elites seeking to preserve their position in a shifting global order. When governments talk about pulling back from China, they rarely mention who benefits most from the new arrangements. Subsidies, tax incentives, and public funds are directed toward large corporations to restructure supply chains, relocate production, or invest in alternative markets. These policies socialize the costs of transition while privatizing the gains. Workers are promised future jobs and long term stability, but those promises remain vague, conditional, and often unfulfilled. The same corporate actors that championed globalization now position themselves as guardians of national resilience. They present decoupling as a correction, not an admission of error. Yet there is no serious effort to reclaim profits earned during decades of outsourcing, no demand for accountability from executives who dismantled domestic industries, and no guarantee that new investments will produce secure, well paid employment. Elite protection takes precedence over structural reform. Economic decoupling also functions as a political shield. By framing economic disruption as an external threat, leaders divert attention from internal inequalities. Rising prices, job displacement, and industrial instability are attributed to foreign competition or geopolitical necessity rather than policy choices. This narrative transforms working people into foot soldiers of an economic strategy they did not design and from which they may not benefit. What is notably absent from decoupling discussions is labor power. Decisions are made in boardrooms and government offices, not through democratic participation by those most affected. Workers are expected to adapt, retrain, relocate, or accept uncertainty, while capital receives protection, flexibility, and state support. The imbalance mirrors the original globalization project, revealing that decoupling is not a break from past practices, but a continuation under a different name. This elite self defense extends beyond economics into ideology. Calls for unity and sacrifice obscure the reality that risks are unevenly distributed. Financial institutions hedge, corporations diversify, and political leaders secure their positions, while households absorb shocks through higher living costs and reduced security. The language of national interest becomes a convenient cover for maintaining class advantage. By focusing on borders rather than power relations, economic decoupling avoids confronting the deeper problem of who controls production and investment. Without democratizing economic decision making, decoupling simply rearranges dependencies rather than eliminating them. It shifts supply chains without shifting power, ensuring that those at the top remain insulated from consequences, even as the system demands renewed sacrifice from those with the least influence over its direction. At the heart of the current conflict lies a contradiction that has always haunted capitalism, now exposed in full view. Capitalism claims to thrive on open markets, competition, and efficiency, yet it depends heavily on state power, borders, and political control to survive. When profits flow smoothly, markets are celebrated as natural and inevitable. When competition threatens dominance, those same markets are suddenly treated as dangerous and in need of restraint. This contradiction is playing out in real time. Corporations spent decades insisting that production should move freely across borders, guided only by cost and efficiency. Governments supported this vision through trade agreements, deregulation, and financial liberalization. The result was a global system optimized for profit, not resilience or fairness. Now that this system has produced a competitor capable of challenging established powers, the rules are being rewritten. Capitalism's war with itself becomes clear when free trade is abandoned in the name of security. Tariffs, export controls, investment bans, and industrial subsidies are no longer described as market distortions, but as necessary interventions. The same policies once condemned as inefficient or socialist are embraced without hesitation when they serve dominant interests. What changed was not economic theory, but the balance of power. The tension between global profit and national control cannot be resolved within the existing framework. Capital seeks the highest return regardless of location, while states seek to preserve authority, stability, and strategic advantage. When these goals align, the system appears coherent. When they diverge, conflict emerges. The current economic confrontation reveals that capitalism has no built in mechanism to manage this clash without crisis. Workers experience this contradiction directly. They are told to compete globally when wages are suppressed, then told to accept protectionism when prices rise. Their labor is treated as a cost to be minimized, while capital is treated as an asset to be defended. The system demands flexibility from people and rigidity from institutions that protect wealth. This internal conflict also undermines the claim that capitalism is purely rational. Decisions are increasingly driven by fear of losing dominance rather than by efficiency or innovation. Investments are redirected not because they are more productive, but because they are politically safer. Markets cease to function as neutral allocators of resources and become instruments of strategic rivalry. As capitalism turns inward to defend itself, it reveals its dependence on the very state intervention it publicly disavows. The ideology of free markets gives way to managed competition, selective openness, and economic nationalism. These shifts are not temporary anomalies, but symptoms of a deeper instability, showing a system struggling to reconcile its global ambitions with the political realities it helped create. The $1 trillion shift away from China functions as more than a policy decision. It acts as a warning signal for the global economy. Such a dramatic move does not occur in a stable system. It emerges when underlying structures are under stress and existing arrangements can no longer absorb growing contradictions. The scale alone indicates that incremental adjustments are no longer sufficient and that leaders believe the risks of maintaining the current path outweigh the costs of disruption. This warning light is flashing because the global economic order was built on assumptions that are now breaking down. It assumed endless growth, cheap labor, stable supply chains, and unquestioned dominance by a small group of advanced economies. These conditions are no longer guaranteed. Demographic shifts, technological change, environmental limits, and rising geopolitical competition have altered the terrain. The $1 trillion move acknowledges that the old framework cannot simply be patched. It is being actively dismantled. Financial markets are especially sensitive to this signal. Capital flows thrive on predictability, and decoupling introduces uncertainty on a massive scale. Investments must be reevaluated, supply chains redesigned, and long term strategies rewritten. What was once considered efficient is now viewed as risky. This transformation forces companies and governments alike to confront how fragile the global system has become after decades of optimization for short term returns. The warning is not limited to trade and investment. It extends to institutions that were designed to manage global cooperation. Multilateral organizations struggle to mediate conflicts between major powers, while rules meant to govern fair competition are increasingly ignored or selectively enforced. The erosion of shared norms accelerates fragmentation, making coordinated responses to crises more difficult. The $1 trillion shift reflects a loss of faith in collective solutions. For developing economies, the signal is particularly troubling. Many built their growth strategies around integration into global supply chains anchored by major powers. As those powers pull back, smaller economies face heightened vulnerability, forced to navigate uncertainty without the leverage or resources to shape outcomes. The warning light signals that the ladder of development is being pulled up even as new entrants attempt to climb. Perhaps most striking is what this moment reveals about the future. The global economy is entering a phase defined less by expansion and more by contestation. Competition over technology, resources, and influence is intensifying while cooperation becomes conditional and fragile. The $1 trillion move does not resolve these tensions. it exposes them. It signals that the system is approaching a threshold where old rules no longer apply and new ones have yet to be established.